The stock market can seem like a complex world full of confusing numbers, charts, and endless advice. If you're a beginner, it's easy to feel overwhelmed or even intimidated by the idea of investing. But here's the truth. You don't need to be an expert to start building wealth through stocks. With a few simple principles, a clear strategy, and the right mindset, anyone can begin investing safely and confidently. Today, we will talk about stock market investing for beginners, so before we get started, make sure to hit that like button. Also subscribe to my channel. Did you know that the average person misses out on potentially life-changing wealth simply because they never learned how to invest in the stock market? Every year, millions of people watch their savings sit in a bank account, earning tiny interest, while others grow their wealth significantly through investing. Imagine having the power to grow your money while you sleep. Yet so many avoid investing because it seems complicated or risky. The truth is, investing doesn't have to be confusing. Today, we'll break down stock market investing for beginners in a way that is simple, clear, and actionable. Stick with us until the end because the last tip will completely change how you think about starting your investing journey. 10. Understand what stocks are. The first step to successful investing is understanding what stocks really are. A stock is a share in a company. It represents ownership. When you buy shares of a company, you become a small part owner. This means you can profit when the company does well, but you can also lose money if it doesn't. Many beginners think stocks are just numbers on a screen, but each stock tells a story. It reflects a company's products, leadership, strategy, and potential to grow. For example, think of a popular company like Apple. Owning Apple stock means you benefit when Apple releases a new product that sells well, but you also feel the impact if sales drop. Understanding this connection helps you approach investing with a business mindset, rather than seeing it as gambling or a quick way to get rich. 9. Know the risk. Investing in stocks is exciting, but it comes with risk. Prices go up and down every day, sometimes dramatically. The market can be unpredictable, and no one can forecast it perfectly. However, risk doesn't have to be dangerous if you understand it. Risk management is about making informed choices and preparing for uncertainty. For beginners, it's smart to start small and only invest money you can afford to lose. Learn to research companies before investing, check their past performance, and understand the industry they operate in. Over time, as you gain experience, you'll be able to handle bigger investments with confidence. Remember, risk is a part of investing, but education and preparation make it manageable. 8. Set clear goals. Investing without a clear goal is like driving without a destination. You may get somewhere, but not where you want. Your goals determine your strategy. Do you want to save for retirement, build wealth over several years, or make quick profits? Each goal requires a different approach. Long-term goals focus on stable, growing companies and reinvesting dividends, which allows your money to grow steadily over time. Short-term goals might involve taking calculated risks to earn faster returns, but these are more volatile. Setting clear goals helps you avoid emotional decisions and gives you a roadmap for success. 7. Learn to read the market. The stock market can seem confusing with all its charts, numbers, and trends. But at its core, it's just a reflection of supply and demand. Prices change based on how investors feel about a company's future. Learning basic market indicators, company financial statements, and trends is essential for making informed decisions. You don't need to become an expert overnight. Start by observing trends over time, reading earnings reports, and paying attention to news that impacts industries. Over time, you'll begin to recognize patterns, making it easier to make smarter investment choices. Remember, understanding the market gives you confidence and reduces the likelihood of panic during fluctuations. 6. Diversify your investments. One of the most important rules in investing is to avoid putting all your eggs in one basket. Diversification spreads your money across different companies, industries, and types of investments. This reduces risk because even if one investment fails, others can balance it out. For beginners, index funds or ETFs are excellent options for diversification. These funds automatically invest in a wide range of companies, giving you exposure to many industries at once. Diversification doesn't eliminate risk completely, but it makes it far easier to manage. Over time, a diversified portfolio grows steadily, reducing stress and increasing your chances of long-term success. 5. Understand fees and costs. Investing comes with costs. Understanding them is crucial. Brokers, mutual funds, and trading platforms often charge fees that can quietly reduce your profits. Some fees, like transaction fees, are obvious. Others, such as fund management fees, are less noticeable but still significant over time. Always check the costs before investing. Low-cost platforms and funds allow your money to grow faster because less of it is lost to fees. Even small differences in fees can have a major impact over years, especially with compounding. Being aware of costs ensures more of your investment gains stay in your pocket. 4. Start small and be consistent. You don't need a fortune to start investing. In fact, starting small is often the smartest approach for beginners. Investing even $50 or $100 a month consistently can grow into significant wealth over time, thanks to the power of compounding. Compounding is when your money earns returns, and then those returns earn more returns, creating exponential growth. The key is consistency and patience. Don't expect instant wealth. By investing regularly and giving your investments time to grow, even small contributions can build a substantial portfolio. 3. Avoid emotional decisions. Emotions can destroy investment results. Fear and greed often lead beginners to sell at the wrong time or chase stocks that are already overpriced. The stock market will fluctuate, and that's normal. Successful investors stick to a plan and avoid reacting to every news headline. Think of investing as a long journey. Prices will rise and fall, but staying disciplined and controlling emotions ensures you don't make costly mistakes. Keeping a clear plan and focusing on long-term goals is far more effective than following temporary market hype. Learn from mistakes. Every investor makes mistakes, even the most successful ones. The key is to learn from them. Analyze what went wrong and why. Was it a poor choice of stock, ignoring research, or reacting too quickly to market news? Keeping a journal of your investments helps track your decisions and their outcomes. Reviewing mistakes allows you to improve over time, gradually becoming a more confident and strategic investor. Mistakes are not failures, they are lessons that make you smarter and more prepared for the future. 1. Start investing now. The single most important tip is to start. Waiting for the perfect moment or the right stock often results in lost opportunities. Time in the market is more important than timing the market. Even small investments made today give you a head start on wealth growth. Begin with companies you understand, use low-cost funds to diversify, and gradually increase your knowledge. Starting now allows you to learn, gain experience, and benefit from compounding over years. The sooner you start, the stronger your financial future becomes. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.